Yes, it's true. Mortgage rates are over 7% again, but what does that mean? Well, according to Mortgage News Daily, which is a pretty reliable source for the average rate, it means that the nationally average quoted rate for a conventional loan that's a purchase for a primary residence with 25% down and very good credit is over 7%. Now, of course, that begs the question as to why this is all happening. And there's a lot of varying opinions on this, but I actually think the answer is simpler than you might think. Now, before we talk about that, I have to at least mention the debt ceiling because that is so dominant in the headlines right now. The gist of it is that the government is technically not allowed to fund everything that they committed to fund because they are at the top of what they are technically allowed to borrow. And you may ask yourself, well, why do they have to borrow money if they said they would fund it? That is because the government operates at a deficit, meaning that they spend more than what they bring in with tax revenue. In order to keep paying for stuff, they have to raise the self-imposed amount that they limit themselves to borrow. This has been a very common thing to happen since the debt ceiling was put into place, but over the last 15 years or so, it's become a massive political bargaining chip. Now, without getting into the politics of the specifics about it, the fear here is that if the debt ceiling is not raised, then the U.S. will default on its debts, which will send not only our economy, but the world economy into the spiraling pits of death. But that has literally never happened. And not that there's not a real risk of that happening, but I think the extremely polarizing headlines could be a little bit of both sides playing politics. Now, that being said, I'm not convinced that this is the cause of the increase in mortgage rates. Let's take a trip down memory lane for a minute. So in March, fears of bank failures dominated the headlines. Remember Silicon Valley Bank? Now, when that happened, investors ran to safe havens like mortgage-backed securities. And so we saw a nice little decrease in mortgage rates. Now, eventually, the really strict fears of the banking crisis subsided, but they still exist a little bit today. And we had an inflation report on May 10th that was decent. Now, due to some factors that I mentioned in the update a couple of weeks ago, that inflation report wasn't the bombshell we were hoping for. And some Fed members obviously didn't watch my update. And so they took the report that we did get as a sign to tell the world how horrible inflation still was and that they still needed to hike rates. Now, at the same time, banks are losing deposits because you can make more money in things like a money market account than you can with a bank. Now, when banks lose money from deposits, they still have to have money to cover withdrawals. So what they have to do is go sell assets like bonds, like mortgage bonds, which then flood the market. And when supply floods the market, right, there's more supply than there is demand, well, prices go down. And so when prices go down on mortgage bonds, rates start to trickle up a little bit. Now, in the last couple of weeks, we have seen a spike up in mortgage rates, but I think it's due to the compounding effect of everything that we just mentioned. Now, I do think the debt ceiling does play a little bit of a role, but again, due to what was mentioned before, I think that that's more of a temporary issue. So what does this mean for the market? Well, when mortgage rates get to the level that they're at, demand does go down. Now, when mortgage rates have gotten this high recently, they haven't stayed there for long, so I don't think there's going to be this massive cooling of demand enough to shift the market, but we will see things slow down somewhat temporarily. Now, what's on the horizon next in the calendar? On June 13th, there's a CPI report that's supposed to come out. Now, the next day is the next Fed meeting. So all signs point to that June CPI report being favorable, meaning it should show inflation coming down, which should be good for mortgage rates. But we've got these other things to figure out as well, right? There's still some fears about the banking sector. The federal funds rate is still a huge factor. And of course, we've got the debt ceiling. So we can figure out the debt ceiling, all right? And then we get a good CPI report on June 13th. Hopefully that should signal to the Fed, hey, inflation is coming down. Maybe we don't need to hike the rate. And if that happens, that should mean good things for the banking sector, which means we get back to basics, right? We get back to talking about how inflation drives mortgage rates, not all these other ancillary things. And again, if we get a favorable report June 13th, hopefully we'll see mortgage rates come down a little bit, which of course will push buyers into the market, drive demand up, give a good support level for home values, right? Now, of course, I don't have a crystal ball, okay, but I do follow these things. That's part of my job. That's how I help educate you. That's how I help educate clients make the right decisions for them. Now, if you want to keep following my thoughts on a more day-to-day basis, as always, give me a follow on Instagram. Don't forget to subscribe to this channel, and have a great day.